Good morning, everybody. Welcome to the Flow Show. A nice quiet day and a nice quiet day yesterday. Nothing happened whatsoever. That's according to some officials. Anyway, morning, Kate.
Good morning, Ryan. Good morning, dear listeners and viewers.
Yes, very much. Right, well, we've obviously got a lot to talk about, so we'll just crack through some of the lesser important stuff, but worth keeping an eye on. Anyway, the RBNZ left their rates unchanged at 5.5% as expected. Nothing really of note in the statement. No hints that they might be edging towards a hike, nor worries about inflation or the like. Going to keep rates where they are as they expect, and inflation is going to do what they expect as well. So water under the bridge on that one, and on we go. Been a few central bankers out. Bailey was out this morning, says, speaking in some magazines, said there's potential for seeing more shocks coming. The labour market explains part of the UK inflation, and he's just been out moments ago as well, saying UK inflation may dip to 5% or less this year, but says high food prices are going to remain going into next year as well. Over at the ECB, Lagarde was out, nothing much at all, basically repeated the usual stance, or the current stance, that rates are sufficiently restrictive. Yesterday, Bank of Canada Deputy Governor Vincent says we're not out of the woods yet in taming inflation. Canadian firms still expect larger and frequent price changes, and that the BOC's view is clouded by an unusual amount of uncertainty. A few comments there, again, could be construed as a bit more on the hawkish side of things, matching what we've heard from those guys. So there is, in my opinion, a bit more of a hawkish slant for the next Bank of Canada meeting. Don't necessarily mean they're going to hike, but they might be leaning a bit more that way. Excuse me. Fed's Bostic, one of the doves, said the Fed is in restrictive territory and that is helping inflation fall. We still have a long ways to go to get inflation back to target. They're not in a hurry to raise rates and not in a hurry to cut either. He sees one rate cut in 2024 near the end of the year. Running to the other perch, Fed's Mester on the hawkish side says she's likely to favour a hike at the next meeting if the current economic situation holds. I guess that means CPI staying sticky and jobs remaining buoyant. So another hike on the table from her, apparently. Just looking at some of the data, kicking back to yesterday, particularly the US. Well, JOLTS, that came in hotter at 9.610 million from 8.8 million expected. Some of the underlying components also looking a bit buoyant. Hires was up, quits was up, separations were up, but you can probably offset that by the hires number as well. We all know what happened from that point. Dollar yen got a good old booting, finally up through 150 on those numbers, and that high there, 150.15, was my buy stop. And straight after that, wallop, we got so-called, or what's been touted as, intervention straight after that. It was a bit of a big hit, as you can see. Didn't last long though. A few questions raised yesterday. Was it intervention? They didn't announce anything. They still haven't announced anything. They've been very coy about that in various comments, which I'll show in a moment. So a few questions. Was it just a phone around, them checking rates, tempting the market, or was it intervention? Now, we've had the cold light of day. It looks like it obviously was intervention, but that's still to be confirmed. Officials, as I say, remaining coy. Pretty much straight after, or not long after, a senior Ministry of Finance official said there was no comment on whether Japan intervened in the FX market. The main man, Kanda, was out as well. also declining to comment on intervention, or whether the move earlier, i.e. the move up through 150, was excessive. He says that they consider implied volatility and various factors when determining what is excessive. One-sided big moves would be considered excessive, and that not announcing in FX intervention has been normal. Suzuki also declined to confirm intervention, came out with the same lines: watching FX with a high sense of urgency, excessive FX moves are undesirable. Now, one of our astute bods in our chat room, Father Ted, came up with a bit of a nugget, and that was comments from Suzuki after they intervened last year. And he said there are times when we announce intervention right after we do it, and there are times when we don't. We are doing this to maximize effects to smooth sharp currency fluctuations. So that was what he said after last year's intervention. So what's going on? Two things. We obviously have spent weeks trying to work out when the choke point is, if you like, for intervention. We were looking at the trade weighted indices and the likes, trying to get our clues as to, you know, when is the high risk of them hiking. A lot of the market had penciled 150 as intervention level. In a way, they've been proved right. But what happened yesterday? Well, we had Suzuki coming out during late Asia, early in the morning yesterday, saying that the level of the yen or the level of the currency is not important. It's the volatility. So box ticked, or box to be ticked, number one, did we have volatility yesterday? The answer to that, in my opinion, is no. 30 pips on jolts is not volatility, but they intervened anyway. What does that suggest? Two things. What did they class as excessive moves? Now, if we look at the moves, you know, pretty much for the whole of the year, it's been a one-way train up. Maybe they class that as excessive. Even the leg since July has been, you know, 1,300 pips. Could be classed as an excessive move. Either way, I'm still inclined to think that the level of the yen was a factor in this, because it wasn't volatility. But for all our guessing, for all our trying to pick out where the choke point may be, and we were all getting nervous while we were up here, it's their job to surprise the market and not to give us as many clues as possible. That's why they've been a bit backwards and forwards on some of their comments. They had mentioned the weighted indexes before, the weighted level of the yen. Now it's not. Now they're talking about implied volatility when they weren't before. So they're all keeping us guessing, which is their job. But what happens now? Now I think the market is going to be a bit nervous. Rallies are going to get sold. There's probably a few people maybe still stuck in longs up here, and they're going to be hitting rallies to get out. The market's not going to be so keen to buy it, although buyers will be found because the fundamentals, particularly from the US side, haven't changed an awful lot. We're still seeing yields bidding up. On that front, I think at the moment that's their biggest problem. They are fighting on the yield front too, yields touching 0.8% today. So that, I think, is their more important battle at the moment than the currency. That's where we should probably going to start seeing some stronger action coming in there, if the market is getting all behind this bond yield move. So anyway, for intervention, they've hit the market. The market's now licking its wounds for a bit. We'll probably find ourselves a bit more balanced. Dips might be a bit harder to come by, but I think rallies get sold, particularly over US data. Any strong numbers there, probably likely to see a fade in that. Give it time. If nothing else comes out, the market might get a bit confident to step in, buying it up again. Maybe we see the same sort of price action we saw last year. We had intervention, it reverses not long after and even makes fresh highs. But we shall have to see if they've actually changed tack now in terms of the playbook that we were potentially going off prior to this move here. Kay, your thoughts?
Well, you covered all bases already, right? That's very nice. The only thing where I am not going to be as 100% sure is if they really intervened. I mean, we've hit a barrier level. You go above, and then the people where the barrier has been executed for, they could have very big orders. And okay, I'm leaning 60-40 to they did intervene, but it could still be that only that the Bank of Japan checked rates and that somebody managing or having been done on the barrier also all of a sudden got a trigger where the market is buying dollars, just overloaded all the algos who are running now in the banks and managing the flows, just overloaded all the systems, and then we saw a pretty abrupt drop. People are long, having to get out of positions. You're hitting machines, not real traders anymore. Machines don't think, they just execute wherever the rate is. And I'm still not 100% sure they really intervened. Now, they are going to keep us guessing because they won't tell us they will. The thing is, which is interesting, is the time of the day again. And again, that is a near certainty. They did not use any other central banks. So there's no ECB, Fed or whatever involved, especially not if it would have been on behalf of, because then they would actually confirm that were the rules anyway before. If they intervene on behalf of the Bank of Japan, normally the New York Fed or the ECB would put out a statement saying that they did intervene. So that one we can rule out. All the rest, I'm not going to rule out anything. And I tried to figure out whether it was them. And if it were them, it was a very, very light one, because otherwise they would have come into several rounds and we would have probably seen levels of 146 or 145 just in the panic move. The fact it lasted for only a few minutes and then we started to trade around 149 again is still having me doubt enough of the fact whether they really intervened. So that's one thing. Now, we must put everything in context. They have been talking nearly on a daily basis, right? About them watching it very, very closely. So that is telling me we cannot rule it out for sure. That's putting me my balance more into the 60-40 that they actually did something. But as I said, it could still be only checking rates and whatever. Now, I am already thinking about perhaps the next step forward, and I think Bank of Japan is meeting. When are they meeting? End of this month or?
Yeah, I think it's end of October. Hang on, give me a second. I will tell you. Yeah, 31st of October.
Yeah. And I'm looking at those 10-year JGBs as well, and then I'm looking at the dollar yields, and I'm looking at the level of the dollar, and I'm going to stick my neck out and say that we may be perhaps a bit closer to Bank of Japan doing something on the next meeting. All of this, especially as well with the yen weakening over the past central bank BOJ meetings, they may get tempted if the government has enough, did enough for their funding also, because I think this morning the Bank of Japan was buying a bit of JGBs as well, but it didn't hold back. The JGB tends to trade at around 80 PPs right now. So I'm tempted to stick my neck out really, really early that the next Bank of Japan meeting, we may actually see a bit more than what we are right now expecting, saying that they are going to keep their hands still until spring next year. So that is something that got me just to think. Now for the interventions, looking at the level where we are now and looking at how the rest is coming back, of course, all those yen crosses got a big hit on the head. If the dollar yen goes 250 points lower, I mean, it's no surprise that all the yen crosses are getting hit. But they are starting to make a comeback already, and I'm looking at stuff like sterling yen, even the euro yen, and all those some of those other pairs. If they don't come in again, or if they really don't come in, or we get another look at 150 on higher US data, for instance, because we are entering in the thick of the data. That is going to give us a very good indication or whether they are serious about the 150 or not. So ideally, I don't know if, well, I guess that now a lot of people are already long yen on the back of what happened yesterday, but I'd say ideally we have another look at 150 just to get a confirmation of what really may be happening over there.
Yeah, it's a strange one, because we were mentioning yesterday, the crosses aren't busting new highs. It's not all a one-way street. It is a lot of dollar in the move, particularly dollar yen. As for your thoughts on the Bank of Japan, if they did act, wouldn't that be more a bit of panic against the market moves rather than tightening for fundamental reasons? Wouldn't it be seen perhaps in a negative light if they did that?
No. If you start to tighten it a little bit, that doesn't look like a panic mode against inflation. You have to.
I mean against these market moves. If this what they've done here is forcing them to act more strongly in markets, and they do that via monetary policy, that's not monetary policy on the fundamentals. That's monetary policy on market moves.
But they could hide behind some of those. They've been saying for months now that the economy is gradually improving. They could hide behind that as well. But of course, yes, taking the yen level as a reason to hide, that would send the wrong message. But I'm pretty sure that they will find a way to say it's not nothing to do with the currency. But fact is, you can hike more easily if your currency is a bit weaker, right? But we will see. I mean, perhaps I'm a little bit too early, and I'm straight away going to reply to Ali, because Ali, I think you're looking at it from the wrong angle. The question is, if machines trading, then what about us as humans? We win against machine, or machines win against us? Who uses machine robots to trade? Well, all the institutionals, for one, use machine robots to trade. That's been going on for the model funds have only been they have been using machines for 15 years, right? And the thing is that if you look at the banks, for instance, I used to be a voice trader, market maker in the banks for 35 years, but we have been gradually replaced by machines as well. They just use algorithms and liquidity machines to handle the liquidity and the positions in the market. So, for instance, if a client wants to, or if just look at us. I mean, you're trading not against the machine, but you're trading in an electronic market. That's the electronic market. The electronic market is replacing the humans. There are virtually no humans left on spot FX trading desks, or just a few, and just to do specific orders or to manage outsized moves where the machines may have an issue. All the rest is done electronically right now. But sometimes, and we've seen it in the past with some flash crashes, we're having less now. But sometimes those machines, they just hit prices where they are because they have an overload, whether it's an overload of dollars, perhaps like dollar yen yesterday, or too much of a shortage if hedge funds at the same time as other institutionals are trying to buy dollars. They just have to cover because they are going above a certain threshold. There's threshold placed in there. Now, are they against or for us? That's a different question. Then you start to talk about last looks and things like that. We are not trading against them, and they are not trading against us. I mean, that's a complete misconception of all the traders. They are not trading against us. Yes, you pay them spreads because you cannot buy at the same price as where you sell at the same price at the same time. But they are not trading against you. Of course, they want to make money, but they want to make money on volume. Those machines I'm talking about. They want to make money on volumes. They want ideally 50% of their clients buying and 50% of their clients selling something at the same time. And usually it's not far off a 60-40 or something, because somebody always has something to do on the opposite side of somebody else. But I mean, don't think of it as somebody wins against us or us winning against the machine. But if you have like a sound plan of trading, you can use it to your advantage at times. Like yesterday, for instance, the dollar yen. Okay, I haven't got a hit on my hedges, but I've got an option running, and I'm hedging it pretty dynamically. And yesterday I had a stop reversal in the dollar yen, and those machines going a bit crazy allowed me to buy dollar yen sub 148, which is absolutely great. My bids for my hedges were a bit too low, and I haven't been hit for 30 points. You know, I mean, sometimes we just take advantage, but that is your plan. That is not, I think it's so wrong to think, for anyone to think we are trading against the machines. Trade your plan.
Or anyone else, or the banks, or anyone else.
No, the banks are not there. Well, banks are always there to take people's money. Otherwise, they were not. They would not be banks. But that's not in FX. That's not FX related. Or it's everywhere. They pay you less on your deposit account, but then they can go into the market and place your money at a higher rate, or buy bonds which are paying better. That's just how it works. The banking system works. But they don't trade against you in FX. Forget about it. I mean, that's completely misconception.
Yeah, no, none of the banks are looking at your stops in gold, Ali. I'm thinking we're going to take them out for a few quid. That's not there. They may look at it on an institutional level, because, you know, that's what used to happen when I was trading on the floor. If you knew that a big bank had a little stop trigger somewhere, then people would try and hit it. But that was at the institutional level, big money. They're not worried about our little beans in the sea down here.
Know, even if you have a bigger account and you trade $10-20 million, unless you're really in the dead zone on a Sunday night, Monday morning, the markets are not fully open yet, and then you have something that came out over the weekend, and the market goes 20-30 points away. Yes, they will trigger your stops, because they likely have no bids against your stop if you're a stop loss seller of something. That is, yes, the machine will trigger it because they don't have the liquidity in front of it. But the machine is not looking at, oh, this is your stop, I'm going to trigger it. No, that is not how those machines are made and programmed.
Yeah, and just to highlight quickly a difference again between the machines and humans. When you get things like that intervention move, machines, as Kay said, they get overloaded, you know, and it's just they're programmed to act. We will need to sell dollar yen, and we need to sell X amount, and we will sell it until we're done, whether that's 100 pips, 200 pips, 300 pips. But a human trader in that situation may see an initial move, do some, then see, right, well, we maybe get a little bit of a bounce. I'm going to hit that bounce, do a bit more, and it's a more gradual thing. You know, there's times when you just have to hit the market wherever it is. But there's also times when humans will take a bit of discretion and just say, right, well, that's dumped off, it's bounced, now I'm going to get off. So rather than selling at you know, right at the bottom, you've scaled in your sales in dollar yen, and maybe you've got better levels than the market actually went to. And that's the difference between humans and machines as well. You know, they don't think, they're just told to do. Hence why we get these bigger flash crashes. You know, they go really fast and hard. Even in the old days, you know, we had crashes, but it took some time to get down there, be it a few minutes or you know, even a few hours. It's a completely different landscape now, and that's the world we live in at the moment. So anyway, yeah, yen, dollar yen particularly, is going to be a bit jumpy now. There's going to be a bit of a lot of, oh, what do we do now type thinking. For me, I'm just going to sit and watch. I've not got any inclination to start piling in second interventions or what the market's going to do. I'm going to let it do its thing. I'm going to see whether the price action develops. Like Kay said, if we get to 150 again, is the market going to be a bit more nervous about taking it through? If we get resistance up there, well, then maybe you've got a chance of a short playing off the level. It's still going to cost you money to be short on this currency. Nothing's changed on that side. But if the market always has the same idea, thinking that 150 is a big zone, then maybe that is the place to try a few shorts and see if we get a move down. But on the flip side, as I said, the fundamentals, these moves in yields, particularly dollar yields, the data, what's coming out of the US side of things, still suggests that the dollar remains bullish. That's going to be the opposing influence in dollar yen. So there's stuff for both sides. And we also wait to see if we get further clarification from officials over what they did or didn't do. So looking at some of the others, not a lot happened, to be honest, in the rest of them. Euro dollar, you wouldn't know there was any intervention in there. That's where it was, right in there. So what was that? 40 pips, 35 pips, zero effect in there. So again, it leads some credence to the fact it might not have been intervention, because you can usually get a bigger move because what happens in one pair triggers in the other. So big, heavy dollar selling somewhere, and you'll see heavy dollar selling elsewhere as well, but that didn't happen. So all these other pairs, as you can see, euro dollar is having a crack at that 105 level. We had a bit of a bounce off the 104.50 area. Can it hold this break? If it does, then maybe we've seen a bit of a bottom here. Certainly this move now that we're breaking back above 105 is going to solidify this downside. So you had your first test here, you've had your second test this morning. That's now giving you a conviction that we may have found a bottom. It may only be short term like this. We may only get a bit of a bounce and then it collapses again. But this is the price action you want to see if you want to catch those knives. May not have been wise to try and catch the knife there. Still a risky trade. Second time around, not so risky because it's held. And now you see what you want to do. Whether we get and hold above 105, that'll be your second trigger. Get above there, start seeing that as support. Then maybe we are heading a bit higher. You can maybe lean against that 105 level with a tight stop just to try the long side from that. Cable, another solid bounce as well. There were barriers at 120.50. Those in our chat room would have known about that. Quite decent size. That's why we were pinging it down there. And this is a pure barrier knockout move. As you can see, 120.50, a little spurt through, knock out the barrier, knock out some stops, and then boom, all the way back up again. Nearly 100 pips higher. Well, we are 100 pips higher since knocking out that barrier. This is why it's important to know this information, because barriers, if you know what they're all about, can give you a level to lean against, particularly on a first touch. You know, you got a decent 50 pips out of that on a first bounce off that barrier. But then you be careful if we keep coming back down to the level. You know, 150 was a barrier in dollar yen yesterday, which is why we didn't get through it for such a time. There are plenty of other barriers in play in various pairs. So for those of you in the chat room, check out the dashboard and the orders and options tab, and you'll get the updated information on those. But otherwise, yeah, we're getting a bit of a bounce. Is it reflective of what's happened in the intervention? Don't know. Dollar's just a tiny bit weaker. Nothing's really changed though. This could be just a dead cat bounce for now. Only if it builds and we start to see more support points coming in, the stepping up of support, maybe it moves into something else. Really not a lot going on elsewhere, Kay, in the other stuff. Stocks are looking a bit dodgy. We've had a first test of that 42 level that everyone's been keeping an eye on. Where is it?
We are bouncing this morning. Sorry, we are bouncing this morning because we we hit pretty lofty levels on in the, well, very low levels in the bond market, and lofty levels on the US yields. If you also look at the 30s, let me see if they took out or hit. Yeah, they hit 501, right? The 30s. So sorry about that. So if you look back left in time, we are at levels that we saw, even above levels that we saw over after the GFC, and back to levels where we were before the GFC. And I think economically speaking, and we're just chatting about it in with Mark in our chat room. Again, guys, if you're not in our chat room, you really should. There's a lot going on in there. Not only do we just talk about effects, but we really talk about a lot of stuff about bonds and everything. I think economically speaking, we are somewhere at levels where I think economically speaking, it's justified. More would start to look rich to me. But the issue is the funding side of things, and we know that the higher yields go, the more, because there's a lot of dollar debt outside of the US being put on over the pandemic, and there's going to be funding problems, and then you have the US Treasury. I still haven't seen their plans for Q4, by the way. But then you start to talk about funding issues, and then you have like, call it a stop run, call it a funding run, call it a liquidity issue, and that could then see oversized moves. But I think we are, if you look at it economically speaking, unless we get really very, very good data out of the US still, we are at levels where I think, if not rich, it should start to look where we should be. That is now my opinion.
It definitely looks a further out duration move, because you look at something like twos and they're absolutely static around this 5-10 area.
Exactly. That's because
where
they will reflect where Fed funds will end up, and economically speaking, and the Fed is already telling us they are watching the impact of the rate hikes, so and somewhere and seeing whether it's going to weigh on the economy. So economically speaking, we can say that we are where we want to be, and then you have the duration is now saying that the soft landing, and the funding needs as well, we see as well the inversion getting swallowed up regularly as well. We were talking about recession is unavoidable because the spreads are showing us the inversion was over 100 points at one stage between the 2s and the 10s, and we are at 34 pips. And we also have to know that mechanically somewhere, but it's a bit tougher to judge in an inversion really. But mechanically somewhere, when your curve steepens, when the dollar curve steepens, it creates demand for dollars actually, but that is something that we need to dig deeper in the fundamentals to really understand this whole process. But
I was saying it's quite funny because there's other central banks intervening as well. Taiwan central bank, having to sell dollars, China having to sell dollars. They're all going to be sell dollars, and then they're going to be dollar liquidity problem. Buy dollars, buy dollars, buy dollars. It's going to be fun and games if this continues with these moves.
And then there's this other mechanical thing as well. I mean, it depends what they want to do. I mean, I've read articles, so the reserves everywhere are pretty cool. I mean, there's no big panic yet. But yes, as you say, the countries are starting to sell dollars against their own currency because their own currency is weakening a bit too much. but it's the wrong side of interventions again. I mean, if you need to sell dollars and you want to keep your reserves at the same time, you need to sell treasuries. What happens when you sell treasuries? You push yields even higher. And then the mechanical effect of it says that the dollar is going to, the per correlation is going to strengthen even more. It's a pretty well, it's complex on the one hand. It's very counterintuitive and counterproductive on the other hand as well. So there's a risk, real risk, that we are in a spiral. If the liquidity problem accentuates, there's a real risk that we are entering a liquidity spiral, which could take us all the way to over the turn of the year. And that's what I was saying already a couple of times. We need to be very, very careful here with what is going on. And but on a pure economical level, I think we have gone relatively far enough, because the real interest rates have been really going up quite a bit, and that is very dollar bullish on the one hand. But when it goes far enough, FX will likely be one of the first instruments to actually react, because the flows of dollar demand will probably dry up first in FX, because the bonds and stuff is more about maturities, rollovers, and things like that, and that effect can last a bit longer. But yeah. FX and perhaps FX is what we are seeing now. Euro dollar is up 0.5% from the lows. Cable is up more than 0.5% of the lows. Aussie is finding bid under 63 and stuff like that. You know, the dollar is really off its highs in FX, and that we will now look at the data to tell us whether we have to jump back in or not. You know.
Yeah, I think that's the key thing. You know, we do delve a bit into the different situations, scenarios going on in the world, but a lot of you guys and girls just want to know how to trade day to day, and really all you can do is just go to your charts, pick your levels, see what's happening, read the price action, find out or know when prices are bottoming, or when you found a bit of a bottom, when things might turn. If things turn, how far are they going to go? You know, is it going to completely reverse? Is cable going all the way back to 124.5, or is this just going to get up to 121.5 and turn around again? So, you know, everything we talk about is stuff that may or may not happen, and markets will change accordingly. But for the intraday, when you're trading, just know what's going on in the market. Know your risks. It's risky now to trade dollar yen. You know, half a comment out of Japan on something, and in a blink we're down 50, 100 pips again. Just know the markets you're in, know which way the wind's blowing, know where your risk points are, because that's all you're concerned about. Where are you at most risk of losing money, in what trades? And if you want to trade dollar yen, go ahead. Keep your risk smaller, keep it manageable. If you do get caught out, it's not going to cost you an arm and a leg. You know, you might just lose a couple of fingernails, like I did with my long attempt. I'm in a macabre sense. I was saying it even as it was trading. This is going to be the high of dollar yen yesterday, and it was. But do you know what my biggest win of that loss was? That I got stopped at my stop level at 149.75 for 40 pips, rather than a gap down and getting stopped out at 147.5. That I consider a bit of a win, because it could have been much worse. But I wanted to keep the trade tight on that one. And really, I only put that trade on because of what Suzuki said that morning, that they weren't worried about the yen levels. If he hadn't said anything like that, I wouldn't have tried a buy stop in dollar yen, because like everyone else, you know, I was getting nervous about being up that high, and that's why I was tightening the stops on my 147 longs, which also got stopped out at their level that I set. So all good on that front. But yeah, just know the market and what it's doing before you want to decide to trade it. Okay, you got anything you want to look at?
Yeah, let's look at a bit of why don't we look at a bit of risk today?
Hang on, give me a second. Make sure. There we go. While you're knocking up your screens, I'm just going to put up, we got the NFP competition open.
You want to share it first?
No, I'll just put the link in the chat.
Oh, okay.
So people can click on that.
As usual, just that little daily look, and I really encourage people to do this, right? Look at what happened on the short-term differential. You print your low on the euro, and now it's starting to go up a little bit. The US yields have come back a little from the highs, and just overlook it with your euro dollar. You will see. I repeat this every day, but it is really a driver of the euro dollar, because look, the euro dollar is higher. When the euro dollar was trading 104.80, we had those retail sales coming out. They were crap, but yet this market is telling that the yield differentials are tightening just a little bit. And look where the euro is. We're 20-25 points higher. So I mean, if you look, the differentials are still the drivers, right? So then I was showing this on the 30s. So this is your level post GFC. These are your levels pre GFC. You see, we've gone higher. We have gone to 535, whatever. But we yesterday we knocked our head against this 5% in the 30-year. I don't know whether technicals really work in there, but I would say, psychologically speaking, unless there is big risk or big needs on the funding side still, I think economically speaking, we have done a really, really big move. July, with 3 months move here. We've really done a big move here, and that was paired with if you look at this is the July move. Remember that euro dollar also hit its high somewhere early July. Is it around the 10th or 11th of July? And since then, this has gone skyrocketing. And what happened? And that's where your long end is really also the driver. And when this when I'm saying that this inversion was getting less, so that the yield curve was steepening. And this is really your dollar wrecking ball right there, right? So it's still very important to look at what's happening in the yields environment. Okay. Cable. I did not really have anything, so I'm going to go with exactly what Ryan said. This was a bit of a stop hunt. There was a bit of a level around 120.60, 120.80, 120.90. So you can see that after the move that we saw in the dollar to the highest level of the dollar, we were hovering around that level, just below. Today we had a little bit better numbers, and I also think that a bit in line with what happened in the yen. I'm not saying the 250 points, but with what happened around 150. When you do a barrier, it can unleash certain flows to take the other side. And then from here, we had a bit better numbers in the UK, and cable is trading actually pretty nicely from the lows. For this afternoon, if ever we are starting to see US data come off, I think we need to look at what happens around 121.85 figure, okay? 121.85 figure. If we start to go above there, I think there is room. There is at least room, that's for sure. But there is room to correct quite a bit actually in the cable. I'm not sure up to where, but there is room for corrections. I would say anywhere, and then we're talking again about this important 123 zone, 123 figure 20. I think it is. I'm not saying we're going there. We have to overcome this hump, okay? But keep a very close eye on what's happening here. We can also falter and then take our next leg lower. This is all going to be decided by what's happening in the dollar data and yields this afternoon. But it does look like the cable market is running quite short, because we had this run up now, and we are not really finding too many sellers here right here and now. That means that the market is probably still running short and not finding too many new sellers in this. Right. Arif, yeah, that 1800, right? In gold. We're not out of the woods, right? We're really not out of the woods. For gold to start to go back up, it can range trade here for a while, but really to go back up, I think we need to retake this one here, 1841. If we retake this one here, then I reckon it's probably a matter of time before we're getting back to 1900, okay? But we need to retake this here and hold, all right? If not, the risk is still there. And again, it's going to be dependent on what happens in rates, right? And on those US data. If we don't recover it, let's say, for instance, at the end of the week, we're still below, I think then the risk is that we're going for another leg. And then it could take us into 1788, and why not even, I'm hearing a lot of people talk about 1760, so it might be that there's something else right there, which I'm not really seeing myself, apart from a bit of a horizontal line. Silver stabilizing as well means a rebound, because there's things were going a bit too fast. But we are here again. I reckon 21.25 is going to be your first level that you want to keep an eye on. And then above there, oh, that's nice. There's a bit of a confluence here around 22 bucks, okay? 22 bucks, and then we are talking about those broken levels here, okay? But a bit like gold, we need to retake levels and hold them, and then we can go back to levels of where we need to decide on what to do with it. I think for as long as we don't recover them, there's a chance of going to have a look in this 2040, 20.25 zone. I think Blake has something around 2060 as well. So this whole zone is going to be very important as well. That for that. Dollar yen is a bit of a difficult one to really chart right now. The cloud is too far away, but we held here on, is it the Tenkan line? We've held this one. We're holding it, but that's I think that's a bit far-fetched to say that this line decided on the hold, right? It was such a panic move. You never know. 20, 30 points is not really. It was really random yesterday. But let's say for the future, this is a move that we are going to have to take into account. But the one that before this happened was really playing ball, and we've been monitoring that a little bit in our room as well with Ben, is this 4-hour cloud. And look at what we are doing since we stabilized. We are trading again around it, okay? So I reckon without further interventions, oh, we actually went, what is this? Oh yeah, this is this. Oh, that's the 200 MA on the 4-hour. Yeah, no, I think it's just random. So we need to monitor what's going on here, and also if I take the cloud away for clarity, if you look at this this one which I was looking at, so you had this big spike lower, and now we are hanging around there again. Okay. All else equal, I think now we look back at the US data and then decide what this yen is going to do. Of course, people are going to get nervous again around 150. But never say never, right? If the data are really good in the US, this thing could trade up to 150 this afternoon again, no doubt. What do we have? We have ADP, and then we have, which is probably the more important one today, do we have the ISM today?
Yeah, I believe so. Let me check. I think so. Yes, we do.
Oh yeah, this is it.
Yeah.
Yeah, the ISM services. That's one which is going to be which is going to be a driver for sure. Okay, so this one we are going to have to keep an eye on. I think I've said enough at least for today, Ryan. I'm giving it back to you, mate. If you want to look at other stuff, fine. The last one. Oh, okay, just the last one, because just to show you that we are transparent in our room. I was short Euromex and I took my stop going through this level. It's Wednesday. We also stopped shy or around this prior zone here. It's Wednesday, so I think if nothing else happens, perhaps with the 3 days funding coming over at the weekend, this could perhaps shy away again. But it does look like people are nervous enough in what's happening now in the emerging markets for me to stay away from this one for a while. So it did cost me a little bit. I made more than that on the dollar yen, but still, for the time being, I'm out of this. I'm want just to monitor it for a while. Not saying we need to take the other side, but I am going to be a bit cautious on this one. Let's put it that way. Back over to you, Ryan.
Thank you very much, mate. Yeah, I think traveling fairly light is my bag at the moment. I've only got a couple of bits on me: dollar China, me dollar CAD, and me euro sterling, and all out of the yen for a moment, just to see what happens with the dust settling on that. Right. Anyway, watch out for that ISM, particularly if we get dollar yen to 150. Could be fun and games. The market's going to be very beady-eyed on that one. Have a great day, everybody. Thank you very much, K-Man, for your valuable insight. Trade safe, trade well, and we will see you all tomorrow. Thanks, everyone.
Good day, guys.